Good afternoon, everybody. Here we are. It's Paul here. Here we are for the first session of January 2019. It's session 21 of Mastering the 4 M's of Trading webinar, the Admiral Markets webinar series, where we will be talking about various elements that can go towards helping you become the best possible trader that you can be. Those who don't know me, my name is Paul Wallace. I'm a trader, analyst, and coach. I hope you've all had a great holiday period. I hope you're all rested and recharged and ready for what I think is going to be a rather eventful 2019. I think it will provide lots of trading opportunities for us all in many various ways. And so this series of webinars from Admiral Markets would hopefully help prepare you for whatever may come across your charts over the next 12 months. As always, we look to begin with a quick risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk, which is not suitable for all investors due to their complex nature. Before entering into a client agreement or making a transaction, please make sure to read the terms and conditions of our service. Consult a specialist if necessary to ensure you understand the risks involved in trading. This presentation and the accompanying videos for information and educational purposes only. Online educational materials are developed by Admiral Markets and distributed by the Admiral Markets Group investment firms for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. As of August 2018, the regulation within the European Union differs for both retail clients and professional clients. In our presentation, we use demo trading accounts where all clients can still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits, the maximum payout of £50,000 sterling as per our negative balance protection policy. Those of you who are new to trading and new to Admiral Markets, there are a range of very good reasons to trade with Admiral Markets as your main broker. They offer very aggressive and competitive spreads on their main trading tools of DAX 30 and Euro Dollar. They also offer the MetaTrader 4 and MetaTrader 5 platforms with their own fantastic Supreme edition. If you have any questions, then please get in touch with your account representative and they'll be happy to help guide you. Also, it's important to be aware that Admiral Markets is a global brokerage and that they are regulated and authorized in many trading regions across the world. Once again, please get in touch with your account representative and they'll be able to guide you to open your account with the most suitable trading regulatory environment. So, ladies and gentlemen, for those of you who don't particularly know me or are joining us for the first session here, okay, then so my name's Paul. It's I describe myself as a discretionary-based method trader. Primarily, I'm looking to trade the sort of dominant trends and the swings of that. I'm very much about keeping things as simple as possible. I like to meld fundamentals, technical sentiment, and some geopolitics into my trading decisions. Primarily, I look to focus on FX indices and commodities, where I'm really just looking to buy strength and sell weakness. That's what I'm doing, particularly in the FX markets. I like to use pullbacks for entries, and just using simple price action techniques as my triggers. When I do my intraday trading, I'm actually a little bit of the reverse. I'm primarily a mean reversion trader, and that is something that we will sort of look at in greater depth later on in this particular webinar series. So if you're a new trader and you're not really too unsure of some of those descriptions that I've given there, well, what I can suggest is that the vast majority of these webinars are on the Admiral Markets YouTube channel. So by all means, please go back and view them and bring yourself up to speed. But also by continuing to join us, you'll be able to understand what all of those terms mean by the end of the series. As always, I like to set expectations for our session. So for me, my expectations are that, I'm here to educate you about the four M's of trading. And I want you to be able to sort of go away and begin to analyze any particular market and be ready to trade it. And also I want to help raise your self-awareness about managing risk and also about managing yourself. For yourself, ladies and gentlemen, I appreciate that I also have a broad range of experience in the room and that, we're operating under, time limitations of 40, 45 minutes. So that sometimes limits me on the depth within which I can go onto in a topic. And so what I like to try and do is I like to focus on tools that you can use tomorrow, something that you can take away from the session and start to capture in your own particular trading style and own trading business. And that's what we're looking to do here with Admiral Markets is give you tools that you can use pretty much straight away within your own trader to help build your own trading business and develop you as a trader. So the whole of the mastering the four M's of trading is really about, if we go back to sort of session one, months back now, is I talked about, from my experience of trading for myself and trading for funds and from actually working with, banks and funds and individuals who are trading, and having probably worked with, hundreds, perhaps thousands of traders over the years, is that realizing is that, the traders who I've noticed who do supremely well consistently, they are fully understanding of and mastering the four M's of trading. And those four M's are markets, method, money, and myself. And invariably, there's a little bit of a sweet spot for traders when they are in a good place in all four of those areas. That is when they tend to trade at their best, and that is when they tend to be consistently profitable. So it's about me being here able to sort of educate you about that and about maybe raising your awareness about what's required to sort of focus on within those four M's. And hopefully, as you've gone through this series with me, is that your understanding of it and your ability to manage your own self within those four M's will improve, and all of that will help sort of drive forward and improve your trading performance going forward. So, what we looked at in our last session of about 2 weeks or so ago was a case of, we did a little bit of a review of 2018, but we also wanted to do some preparation for 2019, take a little bit of the time, sort of, review how your trading had gone for last year, and then prepare, what we are looking to do going forward so that you could make 2019 your best trading year ever. Those of you who joined us, you might remember we talked about business plans, trading plans. We also talked about giving you a little task to take away for your for yourself over the holiday period. If you missed that session, or if you're just joining us now, well, I'd still recommend that you take the time to do this. And we talked about having a business inventory and talked about how all good businesses keep a close eye on managing their stock, and very often they will have stock checks. And in your trading business, it's your trading knowledge, your intellectual property that is effectively like your stock. And as I say, like any good business, it's important to do a stock check once or twice a year just to sort of check what stock you have in your particular business. So, we talked about here, here's your task for your holidays. And I said, if you haven't done it, take a little bit of time this coming weekend just to sit down and do it, because I think you'll be surprised at how useful and beneficial it is as a task. Is, write down everything that you've learned about the four M's, okay? Everything you've learned about markets, method, money, and myself, all right? Just take a couple of sheets of paper, sort of block out a couple of hours in your in your diary. And after that, secondly, write down all the trading ideas which have resonated with you. So maybe you've been watching, the earlier sessions that we delivered here on the Mastering the Four M's of Trading webinar. We talked about some trading ideas. Maybe it was things like the power of the 20-period moving average. Maybe it was pin bars, engulfing candles. Maybe it was trading 3-bar reversals. Maybe you've seen, plenty of other trading ideas. And what I say is, just sit down and take a bit of time and write down which of the ideas that have resonated with you, which of the ideas that you've looked at and thought, yes, those are trading ideas, suit me. They work with my personality. I can grasp that and I can understand it. Then the next one is actually take on that sheet of paper, write down all the trading ideas that you resist or that you don't like. Maybe that maybe you don't, I don't know, maybe you don't particularly like trading channels, or maybe you don't particularly like trading triangles. Whatever you've done it, you've actually found it difficult, or you've struggled, or you've just not really been able to sort of really to grasp the concept. And it's kind of interesting to sort of, when you write down the ideas that you do resist, is actually maybe to ask yourself a few more questions to uncover within yourself why you might have been struggling with that. What is it is there anything in there in particular that has caused that difficulty? And then finally, okay, is sit down and write down what you believe you still had to learn about the 4Ms, all right? Where were the areas of development, okay? And all traders have them, all right? Any trader who tells you that they don't need anything, they have nothing left to learn about trading is talking rubbish, okay? We all have something to learn. We all have areas of development, areas where we're particularly weak. And actually, the part of the thing is about being able to sort of get them down. Okay, there's nothing wrong in admitting that there's areas that you need to develop as a trader. That's no problem at all, no problem whatsoever. Okay, but it's important for us to get them down on that sheet of paper. Remember, this is us taking an inventory of our trading business. So once you've done that and written all that down on your papers, well then now's our chance to review that list. Okay, by writing it down, it helps to provide you with some perspective and also with an element of confidence. And its confidence comes from because actually when you work it day in day out, sometimes we lose sight of the fact of how far we've come as a trader. We lose sight of exactly how much we've learned. But by being able to force yourself to write it down as a bit of a business stock check, well, then it gives you that it gives you some great confidence, self-belief to realize, well, wow, I actually have learned a huge amount over the last 6 months, 12 months, etc. By writing down the ideas that resonate with you, well, then that might be the basis of your next trading method, your next trading idea. The majority of successful traders I see and work with, okay, they have developed their own trading method. Right now, very often that can be from taking elements that have resonated with them in the past and melding that into their own trading method. But if you don't really have a real clear grasp of what actually resonates with you, well then you're struggling to begin with. So you take that time to look at all those ideas, and maybe that's the way that your own trading method will be developed. And then, as I said, writing down the ideas that you didn't like or exactly you resist, well, that gives you an opportunity for reflection upon why. Is it a case of, you just found it a little bit difficult, that particular idea, or maybe you just found it a little bit boring, maybe you just didn't understand it, maybe it simply just didn't, you just left you scratching your head, you just didn't understand exactly how that trading idea worked. Well, it gives you an idea for a spot of reflection, a chance to sort of work out why that is, all right? And it might be a case of that. It might be a case that you have to have a little word with yourself and realize that you have to sort of reapply yourself in those particular areas. And then by writing down those areas of weaknesses and what you still need to learn about trading, well, there you go. There you have the basis for some of your 2019 goals and objectives. So I hope some of you did that over the holiday period. As I said, if you haven't, and you're just joining us for the first time, well, then take a little bit of time this coming weekend. Okay, sit down and do that. I guarantee it's a worthwhile endeavor, and it will help develop you as a trader over the next few months and years. So, what we also talked about is that, as we switch more and more across to sort of looking at the charts themselves and starting to build our own trading plans, okay, I just said, we'd have a look at, the dollar index and 28 of the major other FX pairs. There are more FX pairs you can trade, but actually these are the ones I tend to focus on myself. I also focus on a few of the emerging market currencies, but as a general rule, dollar index and these sort of 28 major pairs are all based around the sterling, okay, euro, Swiss franc, dollar, yen, and Aussie, Kiwi, and Canadian dollar. That gives us 28 pairs, which gives us plenty of trading opportunity. And also, to look at the indices that we're going to sort of take a look at, okay? So, the major American ones like S&P, Dow, and NASDAQ, also European ones like FTSE and DAX, and then the sort of Japanese, and also the Chinese indices as well. We can also have a look at some of the hard commodities like oil, gold, and silver. Some of you may also have an interest in the soft agricultural ones. And not surprisingly, also over the last 6 months, we've seen some fantastic moves in some of the let's say the sort of the bigger American tech stocks. Okay, the Fangs, Facebook, Amazon, Apple, Netflix, and Google. You might also have a few of your own personal faves, and we've had a little look at a few of them over the duration of this webinar series. And then also we can have a look at crypto. Okay, Admiral Markets provide a range of CFDs on cryptocurrencies. Okay, for Bitcoin, Ethereum, Litecoin, and Ripple, and we will include them in because it gives us a real broad spread of different asset classes that we can utilize what we've learned on this webinar series in our own trading. So, if you remember, for the first part of our webinar series, we were talking specifically about in terms of 4Ms, we were talking specifically about, markets and about methods. And we talked about, having almost like a 10-step plan that we could follow, something that, allows you to develop and build the right habits and the right behaviors when you sit down to trade financial markets. If you remember that, we talked about, we focused on the first 5 of those, okay, for the first part of the webinar series, looking at, step 1, defining levels of support and resistance. Step 2, define if there's a trend. Step 3, look to see how price reacts at key support and resistance levels. Step 4, look for price action signals at key levels. And then 5, actually have a look at, is it part of a bigger chart pattern? And as I said, if you're new, you're just joining us for the start of 2019. Well, then all of these previous webinars there are on the Admiral Markets YouTube channel, so you can go there and watch all of them and bring yourself up to speed and get a very clear idea of how we do this. What I talked about, as I said, for those of you new, is that every week we were just going back over these, okay, and adding a little piece every week, because the more you hear it from me, the more you actually do it, becomes it just becomes your standard behavior, and that's what I want. Okay, I want it to actually become your standard habits, behaviors that when you open up any chart, okay, any chart, any instrument, all right, that you actually just go through these 5 steps, and the reason being is because more often than not, it's going to help keep you on the right side of the market, and that's what we're looking to do. Okay, there is no bullish side or bearish side. There is just the right side. Okay, and the right side is about understanding what the market is doing at that time. It's about being understanding the 4Ms in terms of markets and methods. All right, we talked about if you have a trend following method, well, it's important for you to know which of the markets are in trends that you can actually use your trend following method. If you have a trend following method and you're trying to just trade euro dollar because you've always traded euro dollar, but euro dollar at that moment is in a range bound or it's consolidating, well, it doesn't matter how great your trend following strategy is. All right, if the market environment isn't right for it, well, then you're going to struggle. So it is about doing these things because they help sort of make sure that you're on the right side of the tracks. So, we did the first 5, okay, for over the sort of the previous 20 sessions, and now we're going to start to move towards doing the sort of let's say the latter half, okay, the sort of the back 5 in terms of this sort of 10-step plan that we're going to work on. And what we're going to talk about here for today's session and next week's session is we're going to be doing step 6, which is all about risk. Okay, and in particular, today's session and next Monday's session is really literally it's about a sort of a kind of a risk management 101 session. All right, I'm just going to give you a little bit of insight into talking about risk management and money management. We will come back to it in terms of looking at our trade management. We'll come back to that looking at that further down the line, but for today and next Monday session, we're looking at risk and money management. That's where we're actually aiming at. I appreciate some of you, may already have some very, very good risk management principles in place, and if you do, then I applaud you. You can give yourself a pat on the back. But then it never does any harm to actually, to have this reiterated to you as traders, because I firmly believe that risk management is key to being a long-term successful trader. All right, if you're not managing risk, well then you are always going to struggle as a trader. So here's a a quote by a very wealthy trader, Mr. George Soros. Okay, and he talks here about the secret behind success is to embrace risk, not to avoid it. And it's an interesting point. Okay, you might remember we did a session, I think, maybe a couple of months ago now, where we talked about the difference between greed-based traders, and fear-based traders, and about trying to understand which one you were as a particular trader. And part of that, links into this comment of, by Soros about, is the secret behind success is to embrace risk, not to avoid it. A fear-based trader will, where possible, sort of trying to avoid the risk. Okay, a greed-based trader will embrace risk, but perhaps not in the in the best way. So it's about being able to embrace risk in the correct manner. We're traders, not avoid it, and actually, how do we go about doing that? That's what we're going to particularly cover for this week and next week's session. So, the simple fact of the matter is, ladies and gentlemen, you're a trader, okay? So, as a trader, it is your job to take risk, okay? A trader's job is about risk management. That's what they do. It's your job to manage risk and to manage it well, and and that's what we're all about. I know people like to think that trading is about picking a fantastic trade, or is about being always picking a winning. But actually, ladies and gentlemen, the reality is that the definition of a good trader is someone who is good at managing risk. That is what is key. Okay, and so the better you become at managing risk, the quicker your progression will be to profitable trader. Okay, I'm going to say that again because it's important. The better you become at managing risk, the quicker your progression will be to profitable trader. Right, you're a trader. Okay, it's your job to manage risk. That's I can't stress that enough. So what are we going to cover here for the next couple of sessions to help you with that understanding that risk? Well, we'll talk a little bit about a quick definition of it. Talk about how much we risk on each trade. Importantly, how do we go about position sizing for each trade? That's really key. Okay, how do we position size? I appreciate some of you might be aware of it, others may not be. It may be new to you, but actually that's what it's important that I need to know that you can actually position size for your trades. We'll talk about today and next week about some golden rules that we can carry in place in terms of our risk management. We'll look at how we protect ourselves from financial catastrophe. We'll talk about protective stop losses, the importance of stop losses, how to use one that makes sense, a few simple money management rules you can take away, and we'll conclude up at the end of next Monday's session as well. So it'll give us two sessions to basically give us a good grounding in the basic principles of risk and money management. So, for those of you who are academics, okay, you can talk about here as a good academic definition of risk management. Risk management is a predetermined measurement system that measures the loss potential for each trade and incorporates a position size management methodology. This predetermined measurement system contains several controls, i.e. stops, that are used to mitigate the excessive loss of capital and may include an adjustment process, i.e. trailing stops. So that's the nice, rather dry academic. Whereas the sort of trader's simple definition is risk management involves essentially knowing how much you're willing to risk and how much you are looking to gain. Okay, and that might be a little bit too simplistic. Okay, but I'm always surprised that people who are coming into trading don't even really understand that, don't even really know that. Here we are. Here as part of this webinar series for Admiral Markets to educate you upon this, so that you're in a position to do it well and to do it consistently. You might want to break it down even further. Okay, some people would break risk management down even further into risk management itself, which is the management of open trading positions to avoid large losses occurring, and money management being the setting the correct position size in relation to your overall portfolio and cash position. And to be fair, those are quite simplistic definitions as well. But here we are to sort of just give you the sort of the insight that you can take away and work with. But managing our open trading positions is key. That kind of links into elements of trading management, and then also the sort of money management is about setting correct position sizes. Okay, in relation to your portfolio and your cash position. And we'll talk a little bit about that later on today, and also on next session about making sure that you are position sizing correctly. So here's another quote from your man, Mr. Soros. Okay, my principle is to survive first and make money afterwards, and that is absolutely key. Okay, that is absolutely key. Remember, I just said a few slides back. You're a trader. Okay, you're a trader, and your job is to manage risk. Okay, and if you can't manage risk, your career as a trader will probably be quite short. All right, and that's not what I want for you. I want you to have a long and illustrious and profitable trading career, and part of that is about you being able to sort of identify and manage risk as well as possible. So in line with that, here's a couple of simple rules that we'll always take on board. Is that we want to sort of, wherever possible, we want to live to fight another day as a trader. So this photo is it's a bit of a different photo. My background, for those of you who remember, was Air Force many moons ago. This is one of the aircraft I used to work with, a Tornado in the gun sights of his enemy there. Okay, and that is really as a training as a sort of as a battle manager, as a fighter pilot, that actually wherever possible you want to live to fight another day. And the same is said for trading. Okay, is that you want to live to fight another day. You should be able to risk manage your account, your positions, and your capital to an extent that whatever might happen within the market. Okay, last week we had a bit of a yen flash crash. That regardless of whatever might happen in the market, is that you can always live to fight another day. Okay. Perhaps there will be losing trades. That happens to everybody, but you have the ability to learn from it, improve, okay, and come back, live to fight another day, and come back better the next day. And that's what we're actually looking to. That's what we're actually looking to do. Okay, so just remember that rule, ladies and gentlemen. Okay, we're always looking to live to fight another day. You should never have a trade that your entire trading career could be sort of based upon. All right, okay. If it is, well, then you're risking too much money, and you're not actually being a trader. You're not managing risk. You're being a gambler. And very often that happens to with regards to living to fight another day. That on the flip side of that can be quite often I see, especially I might add, young, inexperienced, very often male intraday traders. They start to become quite aggressive. They don't manage risk well enough. They overextend themselves. And in a kind of in military aviation, okay, and in fast jet business, they talk about going fangs out. And once again, once you see the bad guy in your gun sights, you lose all sort of you lose all rationale. Okay, your brain turns to water and pours out of your ear, and they talk about going fangs out. Okay, but they talk about going fangs out for fighter pilots. But I also see that for lots of young traders as well. Okay, they get a bit angry. Okay, they either they're frustrated because they've been sat around all day, or they're frustrated because perhaps maybe the trade that morning was a losing trade. Okay, and they see what they think is a good setup, and then you can see that they go fangs out. Okay, the red mist descends. They go fangs out, and they're just looking to sink their teeth into a trade. Very often that's not necessarily the best thing, because then actually we tend to not making good decisions because we've lost judgment, we've lost our level-headed calmness. And when we see, and I see this, when I'm on trading floors, I see this, angry traders. Okay, they make poor decisions due to ego, anger, external stimulus, or an alternative agenda. They get into something they're not ready for. Okay, it's impulsive trading where they've got no exit plan. Okay, they mess around, wasting time, energy, and resources in the trade, and then finally they have to admit they're wrong and trying to get out whilst maintaining some shred of dignity. Okay. And I see that. Okay, I work with traders across the board. Okay, and just very often, sometimes, let's say, private traders think that that it's only them that suffer it. But I've spent time working in hedge funds and working on bank trading floors. Okay, we are all humans, ladies and gentlemen. Okay, we are all humans. Okay, and it doesn't matter whether you're trading £2,000 or $200 million. Okay, we are humans, and we are still prone to being that angry trader from time to time. Okay, it happens. Okay, you're just human. What it is though is by listening to this webinar, taking on board what we're talking about regarding risk management, it's just that even if you do have a bit of let's say a tough day at the office as a trader, you still follow that rule number one, which is that you live to fight another day. And that's what I want for you. Okay, you live to fight another day. Okay, if there's a mistake made, okay, you're able in a position to learn from it, live to fight another day, and that makes you a better trader the following day. So, rule one was a case of, we live to fight another day. Rule two, what helps us with that is you never, ever find yourself in a trade without an exit plan. which might sound a bit strange, especially for the new traders who are who are with us, because what you find is like amateur traders, new traders, all they want to talk about is entries. Okay, I run events all over Europe. Okay, and new traders all want to come up and ask, Paul, what's your entry? How do you get into the market? How do you get into the market? What's your entry? When do you buy, Paul? When do you buy that? They all want to talk about that. But here's the thing, ladies and gentlemen, right? Professional traders, all right, experienced traders, they're not thinking so much about entries, they're thinking more about exits, okay? They never, ever find yourself in a trade without an exit plan. Very often, as I said, the angry trader is the impulsive trader, and they'll just be taking a trade because they're for reasons that are not in any good judgment, and of course they don't have a particular exit plan. Whereas good professional traders, okay, when I say professional traders, I don't mean somebody at a bank, okay. When I say professional, that is about your attitude, right? That is about the attitude that you bring to your trading business. Okay, it doesn't, as I said, it doesn't matter if you're trading £200, £2,000, 200 million. Okay, you should have the attitude of a professional. That goes without saying. Now, any professional will never ever find themselves in a trade without an exit plan. It's as simple as that. This is all the very basics of risk management that need to be taken on board. So with that in mind, okay, we need to know our exit before the trade is placed. Okay, and there's two types of exits for us really. Where we get out when we're wrong, and where we get out when we're fortunate enough to be right. And we'll start with talking about where we get out when we're wrong. Okay, there's nothing wrong in being wrong as a trader. It's going to happen to you. Okay, it's going to happen to you. It's about how you manage it. That's what becomes crucial to your long-term trading success. Here's a very, very well-regarded, very well-known trader, Curtis Faith. A friend of mine. I've met him, myself, and he put this great quote in one of his books, which is a very good book to read on trading. He thought that each trade possibly could be a winner, but that most probably would be a loser. And I put that up is because that's all about expectation. It's about the language we use. Okay, that each trade possibly could be a winner, but that most probably would be a loser. Okay, that sort of switches your mindset. Okay, it stops you from having a falling prey to outcome bias. It stops you falling prey to becoming that angry trader. Okay, if you have the mindset right that you're putting on a good trade, okay, and it possibly could be a winner, but it probably could be a loser. And if it is going to be a loser, well, you need to have a very clear exit plan, right, for when you're wrong. And here's another great quote from a good book, Mastering the Trade by John Carter. Okay, a very good trader. Amateur traders focus on how much money they can make on each trade. Professional traders focus on limiting risk and protecting capital. Professionals always take money away from amateurs, and it's a great quote there. And once again, I say professional is not about the fact that you work for an institution. Professional is about the attitude you take when you engage with financial markets. Okay, and it is look at that. Professional traders focus on limiting risk and protecting capital. And that's your first and foremost job as a trader. So how much do we risk on a trade? Okay, if we're talking about risk management. And risk profile is a very personal thing, okay? And I'm going to do a session on that probably later on in the series, because it is a very personal thing. Some people are very accepting of risk. Other people are very, avoidant of risk, okay? It's, we talked right at the start, it's about embracing risk, okay? That's the way to do it. It's about how we manage it, right? And it becomes a very personal thing. And I and the rest of the other contributors here at Admiral Markets can teach you pretty much everything about trading. Okay, we can pretty much teach you everything about trading. The one thing that has to come from you is about understanding your own risk profile. Okay, and there's nothing wrong in that. Some people are much more aggressive. Okay, other people are much more avoidant of risk. It's about knowing who you are, and that's that fourth ebb of trading. It's about managing myself. Okay, if you're someone who is, let's say, avoidant of risk, but you're trading a very aggressive risk, a very aggressive trading method, well, then the chances are you're going to have a few struggles, because it will cause you to some let's say some emotional leakage in terms of challenges that you'll feel and find because you're not trading in alignment with who you are. So risk profile is a very personal thing. However, for my own trades and investments, okay, I have very simple rules, all right, very simple rules that, that keep things is that I never risk more than 1% of capital on a single trade. Now, for those of you, who will know me, I like to talk about building positions. but I never ever risk more than 1% of capital on a single trade. Okay, I'm going to repeat that because it's worth you knowing. You never risk more than 1% of capital on a single trade, and it doesn't matter once again what size your trading account is. It's about doing that, okay? Because if you're only risking 1% of your capital, then it allows you to be wrong, okay? It allows you to it allows you to be wrong, okay? You might be wrong multiple times, but you are still adhering to that rule number one, which is that you'll live to fight another day. That's what I want you to take away. So what does that actually mean in our trading? Okay, how do we look at that? Well, here's we're going to do a little bit of sums just to make it very clear for you. Okay, just to see how we can work it. So we have a trading account of £10,000, and we will only risk 1% of our trading account on a trade. Okay, so ladies and gentlemen, how much are we looking to risk? Okay, how much are we actually looking to risk? Some of you might be able to put the answer there in the sort of the chat box. Okay, you might be able to sort of see that, and you might know that. It's what I wanted is to be able to make sure that, as I said, that you're all absolutely very clear on what's required in terms of the risk management. So if we're only risking 1% of our trading account a trade, how much we're risking? Well, that's right. What we're doing is we are risking £100. Okay, that's not £100 a point. Okay, which some people sort of take it as. It's £100 for the entire trade. Okay, so if that trade is wrong, and if we step away with a losing trade, well then we've lost £100 for the entire trade, which is only 1% of our trading capital. We'll just do a couple more examples just to make sure it's very clear. Okay, so in this particular example, we've got a trading account of £3,700. If we were only to risk 1% of our trading account, what would that be? Okay, you can do that in your head, or you might need a calculator depending upon how fast or sharp you are. But the question is, how much are we risking? Well, the answer is we're risking £37. Okay, not £37 a point. Okay, £37 for the entire trade. Right, we never risk more than 1% on a particular trade. Now that might, some people who risk much less than that. Okay, in some of my trading, okay, my intraday trading, I risk much less than 1% on a trade. But what we want is that for it to be a sort of the upper limit. So if you've got a trading account of, let's say, £1,000, okay, and you're only looking to risk 1% of your trading account to trade, how much would you be risking? Hopefully you'll be able to work that out pretty quickly. All right, that's right. You're risking £10, not £10 a point, £10 for the entire trade. All right. Now what we need to do is we need to work out how much we trade per point. Okay, and this is what we call position sizing. And we'll do a little bit on it in this session, but we'll also do a lot more on it in the next session next week as well. This is about an introduction to risk management, money management, and position sizing today. So let's say we've got our trading account of £10,000, okay, and we're only going to have capital risk of 1% of our account on a trade, which we'd worked out before is £100. Okay, so we're only risking £100. It turns out today that we're trading pound against the dollar. Okay, let's say for example, we're going to be long, okay, in cable, and our entry is 159. Okay, the handle 159, and our stop loss is 158.50. So we know what our capital risk is. Okay, 1% of our account. But what we need to work out now is what's our trade risk do we have? Well, if we're getting in long at 159 and our stop loss is going to be at 158.50, well then how many points of trade risk do we have? So we've got 50 points of trade risk. That's what we have. Okay, the difference between 159 and 158. That's our trade risk. Okay. Now we also know that we're risking £100. Okay, our capital risk is £100. Our trade risk is 50 points. So if we're risking £100, our risk is 50 points. How many pounds point can we trade at? Well, what we're looking at is a pretty simple there. In that particular example, we'll be looking at trading at £2 per point. Hopefully you can see that 50 points times £2 a point will give us a total risk of £100. Okay, so we know that we're not going to risk or lose anything more than 1% of our account on a single trade. So here's, we'll do another couple of examples, okay? So, once again, we've got a trading account of £10,000. We're only going to risk 1% of our account on a trade, which we've worked out means we're only ever going to risk £100 on that trade. This time we're trading the euro against the dollar, okay? And we're going long at 136 handle, okay? And our stop loss is at 135.80. So how many points of trade risk do we have? How many points in terms of the difference in pips between our entry and our stop loss? So in this particular case, our trade risk is 20 points. So, if we're risking £100 and our risk is 20 points, how many pounds per point can we trade at? So hopefully you can do those sums, and you work out that it is, we're trading at £5 point no more, and that's how we will. That's how we would do that. It's another example, okay? We've got a trading account of £2,000. We're only going to risk 1% of our account on a trade, so we're risking £20. Once again, we're going long in pound against the dollar at 162.20. Our stop loss, okay, is at 161.80. Can you work out how many points of trade risk that we have in this particular example? Well, that's going to be 40 points, okay, or 40 pips of trade risk that we will be utilizing in this FX trade. So if we're risking £20 and our risk is 40 points, how many pounds per point can we trade at? So hopefully you can work that out. That would be a particular case of 50 pence a point at which we can trade. That's what we'd be looking at. And then here's the final example. Okay, we've got a trading account of £500, which we're only going to risk 1% of our account on a trade. We're risking £5. Okay, that's 1%. We're going to be long in pound dollar against 163.80, and our stop loss is 161.80. How many points of risk do we have? Well, in that particular case, we've got 200 points of trade risk. Okay, and if we're risking £5 total capital risk and our trade risk is 200 points, how many pounds per point can we trade at? Okay, well, if you might be able to do the sums in your head, or you might be able to use a calculator, but that's about 2.5 pence per point. Okay, which it's unable to. Okay, the reality is that that you can't trade down at that small an element. So if you can't, well then this is what you have to do. You have to move along. Okay, that if your risk management principles that don't met, if your position sizing doesn't meet the criteria, well then actually we just move along. Okay, that trade is no longer valid for us based upon our risk management principles. So there's just a few points to know. Is that money management is one of the most simpler topics to grasp. Okay, but it seems to be one of the hardest to follow for lots of traders. Right? And most traders lose money simply because they have no understanding of or place no importance on risk management, especially greed-based traders, which we talked about in one of the sessions earlier on in the series. Okay, they either just place little or no importance on risk management and they get caught out. Without a sense of money management, most traders simply hold on to losing positions for an extremely long amount of time, but take profits on winning positions far too prematurely. Okay, and that in itself is one of those elements of the 4 M's of managing myself, about ensuring that that we're able to do ourselves a good to put ourselves in the best possible position for trades. Okay, and but as a general rule, humans, okay, without that sense of risk management, money management, they'll hold on to losing positions for too long. Okay, and they take profits too quickly, too early, and that in itself is another topic we'll talk about when we come on to behavioral biases. So that's for today's and next week's session. We're going to go into it more depth in terms of the position sizing element. Okay, we'll go into it more, but actually what we wanted today was to start to introduce you to understanding step 6, which is risk management. For the future sessions we're going to cover, okay, in 2019, we're talking about 4 M's money in terms of risk management, trade management. But we're also going to be talking about the 4 M's of myself, managing performance, recovering from a slump, improving performance. Then we'll look at some shorter term trading, and then we'll also look at some advanced trading tactics. As always, I talk about, remember to manage those 4 M's of trading within your own trading business: markets, methods, money, and myself. Just take a little bit of time to work out, is it all in alignment? Okay, if they're not, then you shouldn't expect outsized returns. And it's something that you have to monitor, those 4 A's. It doesn't have to be, terribly in depth or detailed. It's about just understanding where you are with regards to those four particular areas. So I hope you found that useful. I hope if you're a new trader that it's given you a little bit of insight into your risk management. As I said, the second part of it is next week, okay, and that will actually help us give you a little bit more insight and depth into risk management, money management. As always, if you have a question, you're very welcome to sort of contact Admiral Markets and call them on the London number there, 02077 264,003. Drop them an email at hello@admiralmarkets.com. And in a few hours' time, what you'll be able to see is this video up on the YouTube channel at youtube.com/Admiral Markets and also on the facebook.com/Admiral Markets Global Group. I hope you found that useful. I hope they found that interesting. For those of you who are experienced traders, I hope you found it a good refresher. I wish you the very best of success in your own trading this week, ladies and gentlemen. As always, I'll be on the real-time daily trading ideas tomorrow morning, London, 10 o'clock. Feel free to join us if you want to see some of my up-to-date market analysis and trade ideas. And failing that, as I said, I'll see you next Monday at 4 o'clock for the next session in the Admiral Markets Mastering the Four M's of Trading webinar. Best of luck with your trading, and I look forward to speaking to you soon. Many thanks. Thanks, Supu. Thanks, Phil. Have a great week, and I look forward to seeing you next week. Thanks.